Chapter 7, Part 2, Accounts Receivable and Uncollectable Accounts. Now, there are two ways of where you're always going to have, well, usually you're going to have accounts that you can't collect, and GAAP really likes you to estimate them because they think it gives you a more realistic appearance of what you're going to collect on your accounts receivable. So, we have the direct write-off method, which is not acceptable under GAAP, but it's required by law. For your tax return, you have to put actual, but on your financials, you have to use an allowance account. So when you use the direct write-off method, you're going to write off bad debt as it occurs, and when you do, it's going to affect both the income statement and the balance sheet. The bad debt expense is the actual amount written off during the year. So, the other method we have is the allowance method, which sets up a contra asset account called allowance for uncollectables. Write-off of bad debt has no effect on the income statement or balance sheet. The bad debt expense is an estimate, and when we come up with the estimate, that's when it's going to hit the income statement and the balance sheet. But the actual write-off is going to go against a reserve. Now there's two allowance methods. One's called a percentage of net credit sales. This is normally used during the year because what they really like is the percentage of receivables or the balance sheet method. And this is usually what's used at the end of the year. Now there's two ways you can do it. You can have an aging schedule, or the method we cover is the composite rate. So let's start with percentage of sales. It's going to always be bad debt expense is going to equal credit sales times the percentage. Remember, it's only credit sales. Now again, many companies use this for estimating bad debt during the year. Now the composite rate based on accounts receivable, you take the percentage times the gross accounts receivable will give you what the ending balance should be in the allowance for uncollectables. So to estimate bad debt expense, what you have to take into account the ending balance in allowance for uncollectables plus or minus the credit balance in the allowance count. So that will give you bad debt expense. So again, you're going to take this estimate that you come up with, which is what the ending balance should be, plus or minus the balance in the allowance for doubtful uncollectible accounts. Now, many companies, again, use this at year end. So let's take a look at examples. So let's take a look at first the direct write-off method. We have a beginning balance of $600,000. We wrote off $41,000 during the year, and they had total credit sales of $5 million, and they received cash of $4.9 million. What's our journal entries? So bad debt expense is going to be $41,000, and when we book it, it's going to affect both the income statement and the balance sheet. Now there is no estimate for bad debt expense, and bad debt expense equals actual write-off. So we start with our beginning accounts receivable balance plus our credit sales minus our payments less our write-offs tell us our ending balance in accounts receivable is $659. Now let's look at percentage of sales. Percentage of sales. First, we know that we have in the allowance account, we have a beginning balance of a $30,000 credit, and that is the normal balance of that account. During the year, we wrote off $41,000, and then we have sales, and we had cash, and bad debt expense estimated at 1% of credit sales. So, first, we're going to write off our bad debt. Now, if you notice, it goes against the allowance for uncollectible accounts and accounts receivable. These are both balance sheet accounts, so it nets out, which means it has no effect on the income statement or the balance sheet when you actually write off bad debt. Now, I like to do T accounts, okay? I still do them. It really does help visualize for you what's going on, especially when you've got all these accounts. So what I like to do is first put in what's our beginning balance, and then we had these write-offs. and then we had the sales and the payments. Now, estimate of bad debt expense is $50,000. That's what we book as bad debt, and that is the bad debt expense. It's not the $41,000 that we wrote off. It's the $50,000. And that gives us our ending balance, and our net accounts receivable is $620,000. Now let's take a look at the balance sheet method. Now for the balance sheet method, again, we're going to do the same entry. Allowance for uncollectables, accounts receivable, again, has no effect on the income statement or the balance sheet. Now you really need T accounts when you do this method. So we're going to start with our beginning balances. We're going to show our write-offs and our sales, and now we know what the balance is in our accounts receivable and allowance for uncollectables. And if you notice, we have a debit balance, and we know we're going to have to correct that anyways because you can't end with a debit balance and allowance for uncollectables. Now we're going to estimate bad debt expense. It's going to be 5% of that ending balance of $659, which tells us the balance in allowance for uncollectables is supposed to be $32,950. How do we get that? Well, to get the credit balance, we're going to take the debit balance plus the $32,950, which has to be the ending balance, which means that we're going to have bad debt expense for the year of $43,950. Now, when we enter that, if you notice, we do get that ending balance that we were looking for. 32 and which is the balance that we were looking for right here, $32,950. Now that gives us net receivables of $626,050. So remember, what we do is normal companies would use percentage of sales during the year, and then at year end they would come up with an estimate based on the balance sheet, and they can do aging of accounts receivable, which normally is just done on the computer. That's the only reason I didn't cover it, or percentage of accounts receivable. Now, what happens when you get a payment on an account that was previously written off? Well, under the direct write-off method, you would debit accounts receivable, credit bad debit expense, and then show the cash. Now, the reason we have to do this is you always want to reestablish the accounts receivable because you have a subsidiary ledger that keeps track of how well people pay you. And you want to know that this customer did come back and pay you, even if it was late. All right, so if we use the allowance method, as you can see, it would have, so in the direct write-off method, if we had somebody pay a prior debt from previous years, if you notice, it'll affect the balance sheet and the income statement. Under the allowance method, it does not because both accounts are on the balance sheet. And then again, we reestablish the accounts receivable. That ends this presentation.